Good morning, everyone. It's Friday, TGIF. These rooms keep getting better and better all the time. It's just been an extraordinary run we've had the last couple of weeks. Today, we're raising the bar yet again with a speaker who really needs a little introduction, although maybe because maybe in London he doesn't, but in the States maybe he does. I was teasing Julian earlier this morning. He's not well known enough here in the States given his stature and how right he's been on market. So I'm really, really excited that Julian's going to be with us this morning, speaking on what's going on. He's been in the vanguard of getting this right. I think the Fed and Jerome Powell could actually take some lessons from Julian. And I think you're going to be very interested to hear what Julian has to say. I'm also thrilled that a good mutual friend, Tommy Thornton. Tommy knows Julian really well, and I've known Tommy really well. Tommy's co-hosting with me, so good morning, Tommy. Good morning, Julian.
Good morning.
So Julian, you're actually in Chicago. Do I get this right? How are you spending your time these days? You're a Brit, but what, you're going between like Colorado and Chicago? Like what are your logistics?
Yeah, so my daughter went to school in Connecticut up by Tom, and so I didn't need to be in Denver anymore, which wasn't my favorite city, to be honest. I love the mountains, but I'm not a huge Denver fan. It's not a big enough city for me. So since I'm a Brit and I can't stand sticky heat, that kind of writes off the whole of the southern US. I spent 20 years in Manhattan. So I was kind of left with Boston, Chicago, and Boston's not that much bigger than Denver. So I plumbed for a period in Chicago, see what it's like. So I have a great view of the lake, downtown. It's pretty fantastic. The summer's been great. The winter was a little brutal, but that's when I go to Colorado.
That's great, Julian. So, Julian, I know you're on a tight schedule. We're very fortunate. We've got a 12 o'clock noon hard stop. The room, by the way, we'll have a hard stop at 12:30. So, Julian, you're free to go to 12, but we're probably going to go on for a half hour then. This is not going to turn into one of our 3, 4, 5-hour marathon sessions. I have a hard stop at 12:30. So don't worry. This is like going to the dentist, Julian. It's not going to hurt and we'll be brief. So it'll be easy. This should be a labor of love for you. All right. So let's get right into it. So, Julian, you've been out in the vanguard correctly calling the inflation situation for what it was. I mean, all people have to do is go back and look at what you were saying 6, 12 months ago. It's all there. Pay attention to that man. Pay no attention to that man behind the podium at the Fed press conferences. Instead, pay attention to Julian Brigden. So, Julian, so you've been very clear, and I urge everyone to go on YouTube, go on the internet. You can see Julian's recent interviews on Fox Business News and other channels. Although I don't think you're on the Cartoon Network, thank God. So anyway, Julian, could you give us an update, a sort of mark to market on how your thinking has progressed? Maybe just sort of go on a rant for a few minutes, and then Tommy and I'm sure will have plenty of questions. There'll be a lot of really good questions from the audience. But sort of mark to market your views on inflation, particularly in light of the fact that recently there seems to be a growing consensus that we're going to have a recession. When exactly, we don't know. Maybe it already started. Maybe it hasn't. Who knows? But, what do you think about inflation, and how does the slowdown in growth impact your inflation call? What do you see happening for inflation for the next few months? In just in the bigger picture scheme of things, it's not even so much whether we saw the high print or not, but just generally speaking, the impact of inflation and how slowly it's going to be to go away in terms of how it overall impacts markets. So without further ado, Julian, the floor is yours.
That's George. Quite a few things there. I mean, look, we've generally been in the sort of structural pivot towards inflation from a sort of disinflationary world. And let's put some perspective on this. A couple of fantastic papers written by the Bank of England, which we highlighted like 7 or 8 years ago. 7 or 8 months ago to our clients by the Bank of England, looking at sort of historical bond bull markets over 800 years, periods of extremely low real interest rates, and they were looking at in comparison to the current bond bull run that we've obviously had for the last sort of 30 odd years. And what was very interesting, George, was just the similarities that we'd seen in those, and how they were caused by periods of extensive growth in global trade, or, frequently in the sort of 1600s, you were really talking about intra-European trade because it was one of the most developed of the global economies. Expansions of sort of innovation in finance and expansions of innovation in technology. And we're all arrogant and with such short-termist views in the world that we tend to think that as we live here and now is so radically different from history. Well, I would postulate that, things like the internal combustion engine, things like the Clipper ship, were arguably more important than bloody Salesforce.com or software innovations, right, in terms of really spurring global trade, creating financial innovations. And what the bank did was they looked at these periods. This would be the third longest bond bull market that we've seen in history, period with low real rates and low inflation. And they looked at how those kind of ended. And there was an overriding theme, and they ended basically with typically a pandemic and or a war. So as we've looked at the big picture dots, right, if we looked at Trump's, for example, first foray into like blowing the doors off fiscal profligacy, right, taking out any fiscal hawks to the bike shed and shooting them through the forehead, we kind of saw these dots starting to move. We saw a society that was ready to embrace greater fiscal spending because of growing inequality. We've been writing about this coming spat between the US and China and what that would do for global trade, what that would do for corporate profits. We've been writing this series called RIP Corporate Capitalism, where we kind of saw peak Thatcher, Reagan, corporate capitalism, really starting with the 08-09 circuit. So we've been more in that kind of, the dots are aligning for a structural upturn in inflation. Now, as I said, you look at those Bank of England papers, they tell you that the overriding theme is disinflation, has been for 450 years, but it doesn't mean you can't get these extended interludes where you get bouts of rising inflation. And the two that most interest us are the late 30s into late 40s, so a 10-year period, and the late 60s in particular into the 70s. And we've been kind of playing this late 60s analogy for a while because it seems fitting, particularly with post-COVID, where you've had this big burst of fiscal spending, and now where the model seems to be, if you look at, say, the proposal of Biden to send out, gas cards, or you can see it in Austria where they've offered people 1,000 euros to offset higher energy prices, is to this model of sort of governments coming in and supporting things with fiscal, not just purely monetary. And that combo is extraordinarily powerful. We run an excess stimulus model, which we built in cahoots with a client of ours who came to us last April. And actually our first inflation trade was in March of 2020. Off the lows, we bought break-even inflation, 5-year break-even inflation at 50 basis points because they got sold by the risk parity guys who had them as their inflation hedge, and as risk parity deleveraged, those things got absolutely trashed. And inflation is somewhat cyclical, so it's a great trade. But starting in January of 2021, we really banged home the message that inflation is the most important story here. This thing was getting out of hand. We'd done this work with this client. It suggested that inflationary pressures won't peak until we enter the fourth quarter of this year, and then won't abate that much. And while I don't want to get too cute on a model that runs 18 months in advance, it actually, if I stick to the letter of the model, it tells us that we're not going to see peak core CPI until the September print in October at 9.5%, which is 350 basis points higher than it is currently. So I think at the bare minimum, we're looking at a very sticky inflation situation. I think the equity guys, particularly the talking heads on the financial TV stations that we see, are always trying to be the glass half full guys. There's a simple reason, right? And your leaders, this, George, but your listeners should, is that really their ratings are a function of a rising equity market. And, when you're in a bear market, the advertising revenue tends to fall and the revenues of the TV station fall. So they're sort of incentivized, probably almost directly, to be permabulls, right? And to be cheerleaders. So I think inflation remains very sticky. I'm very worried about inflation prints in Europe as well. We talked about that before the show, George, and I'd said that if you take the 3-month rate of change in German inflation and you annualize it, it's running at just shy of 17%. So I think it's entirely reasonable that in the Eurozone you're going to see low to middle teen inflation prints, and that's going to put pressure on the long end of the bond market because as bund yields get dragged higher, they're going to take treasuries with that. That's important for people to understand, even if they don't have anything in Europe and they don't invest in Europe. Just understand that outside FX, which is utterly fungible, the sovereign bond market is the next most fungible of markets because you can create a JGB, which the Japanese do, out of treasuries with an FX swap, right? As long as you're prepared to, you think those credit risks are the same. So I still think there is quite a lot of inflationary pressure there, but I am now starting to see signs of accelerative weakness in the real economy. We can talk about why that weakness is coming through, because I don't think it's what people think that's actually driving this, and it's a fundamental problem that we face here in the US, and I think it's a I think it's a potential policy error that the Fed is heading into, but I am starting to see more accelerative weakness in the US economy, and that's why for the first time this last week we started to put on a couple of more recessionary bets. We think we're probably a little early. We've left ourselves some room, but I think you're going to see some weaker data coming through. I don't think it's going to be weak. I mean, this is the thing. The Fed is betting on this weaker data, so it's not going to allow them to step back, okay, which I think the equity boys misinterpret. And I also think that the equity boys don't understand that weaker data, which could end up being, I can see a situation where this could be an ugly recession, also means that earnings per share have to drop and earnings have to drop. And that's the next shoe, I think, to drop in the equity market. So I do not believe I'm going to be a seller of this rally. There's some big gaps on the charts. You know, if you look at the S&P up to around sort of 4,100, I think there's a gap on the S&P. I'd love it to get up there. I'd love it to get up there.
Yeah. So you want to get it up there so you can pound it again. So
yeah.
So Julian, let's extend it a little bit. So a couple questions around that. So first of all, this fixation about inflation, whether it's topped, it hasn't topped, you don't think it's peaked, but let's assume it has peaked. Let's assume you're wrong. I mean, seems to me, I'm not just putting words in your mouth, but seems to me, in my opinion, I'll make an I statement, that people are focusing on the wrong thing. It's not has it peaked. It's how long is it? I like Jim Bianco's definition of transitory. Transitory being that if you don't do anything, it'll come down to an acceptable level on its own. And measured by that yardstick, is definitely not transitory. So are people focusing on the wrong thing by just whether in the fixation on the Cartoon Network, which is, it's peaked, it hasn't peaked. I mean, what you're saying is that's not really the right, if I understand you correctly, that's not really the right question, the right thing to focus on. It's that inflation is going to be a problem with us for a while, and the implications for monetary policy. So I'm not just putting a word in your mouth. I think there's a question there somewhere. I'm just giving you my stream of consciousness.
Right.
So how do you think about inflation in the context of the Fed's ability to ease up on monetary policy, still their need to tighten financial conditions to reduce aggregate demand to bring inflation yet down further to their 2% target?
So I think really you're sort of in a game here of nominal GDP targeting, and I think this is what people kind of forget. You know, the equity guys have got fixated about this idea of it's inflation. That's the problem. It's not, right? It isn't singularly inflation. Powell has made it absolutely damn clear in every single utterance when he gets an opportunity that there is a mismatch in aggregate demand and aggregate supply, in particular in the labor market, right? We are growing well above trend, right? This is not an emerging market, right? Our trend growth is not 6 or 8%. It's, according to JP, it's 1.75, right? So at a bare minimum, you have to get growth back to trend, okay? And that's why he keeps talking about financial conditions in aggregate, because that's how you do it, right? You know, I loved earlier in the year where you would hear these equity people on the TV channels going, well, we've priced in 4 rate hikes and the market can take it. So the inference being, so now we can rally. And I kept saying, and I'm getting increasingly old, so I'm allowed to do this, George. I'm allowed to shout incoherently at the TV, right? Then you don't bloody get it. If you can take it, then we need to price more than 4 rate hikes in, right? Because Fed funds are nothing in of themselves. They're purely and utterly a signaling mechanism, right? They're a signaling mechanism, as Jay Powell's made it very clear, to tighten financial conditions. And one key metric of financial conditions is the equity market, right? So we need to get this equity market down to a level that slows growth. And now we're back into one of those periods, and we've been in them a couple of times. We were back in May, where you're kind of, balancing that clutch in the car, right? For those of you who, old enough to remember when you used to drive a manual, certainly in this country, right? But you're balancing the clutch, right? So if bonds rally a bit, yields fall, and the equity market goes, ooh, hurrah, and tries to rally, then bonds have to sell off and yields have to rise, because otherwise you're easing financial conditions. And I don't think financial conditions are tight enough yet even to get us much below trend growth. And you do need to bring trend growth down a hell of a lot to wring out this degree of inflation. I mean, I know they're playing an element of optimistic disinflation, which was a strategy that Greenspan followed in the mid-90s, where he kind of tightened a little bit, then hoped that things would roll and bring them back. But it's not clear to me that that's going to happen quite so easily, and in which case, at least at face value, Powell has girded his loin and is prepared to have a recession. He told you with that employment forecast in the SEPs, the forecast that they do, and a 0.5 increase in unemployment is a recession.
Right. So, Julian, that's terrific. So let's go down a couple other tangents here, and then maybe Tommy's got a question to follow up, and then we'll open up to the audience. As we're all very U.S.-centric here over in the States, oftentimes they don't pay sufficient attention to what's going on elsewhere. Could you just speak to, one, Europe? You mentioned the inflation numbers in Germany, but also the tensions now that are appearing and manifesting themselves in the sovereign markets, spreads between BTPs and bunds, as an example.
Yeah.
You've got two issues here. One is you want to keep spreads tight. The other is you got to raise rates to keep inflation down. Those two are odds with each other. And then the other potential fault line out there, source of imbalance, is what's going on in Japan, where the widowmaker trade for decades now has been shorting JGBs. The siren calls beckon me up once again. I'm not suggesting that people go running headlong into the widowmaker trade, but it kind of reminds me of Stein's law, that which can't go on won't. At what point is Kuroda going to blink? And because if they don't do something on the yields, the yen's going to go much weaker. You and I spoke about that, and I believe that's your view. So, two questions: one, Germany, Europe, and spreads, and then two, Japan. Over to you.
So Europe, I think, is at an interesting inflection point in the sense that you've seen this collapse in consumer confidence in Europe. Not surprisingly, because they were threatened with, thermonuclear war on their doorsteps, and all the gas is going to be shut off, and they're not going to be able to produce anything, and they're not going to have jobs, and not surprisingly, consumer confidence imploded. And if it stays that way, George, they're screwed. I mean, they're utterly screwed. Because you're looking at a recession that's potentially deeper than the global financial crisis. However, there's some unusual standouts that have not yet followed. So business confidence, even though it's weak, come off the highs, is not weakening yet, really, to anywhere close to consumer confidence, suggesting maybe that what really happened is the consumer overreacted potentially. So let's see if that consumer confidence starts to rise. But businesses haven't dropped back. Employment remains pretty solid. Now, don't get me wrong, this could just be a lag and it could all turn south. And as I said, if that's the case, then the ECB is going to back off doing anything and they're going to be looking in a highly stagflationary environment, and we'll see where the euro goes in that situation. I mean, it'll be a mess. But the inflation problem is a problem for this central bank, right? I mean, people forget, even in a stagflationary environment, central banks cannot allow real rates to get more and more and more negative, right? They still have to, at a bare minimum, keep up with inflation. And so I look at this inflation metric and I look at what Europe is actually running in terms of policy, and it's ludicrous. It's truly ludicrous.
So Julian, it's ludicrous, yes. But I mean, which is more ludicrous, the fact that real rates are so negative, or the fact that spreads are spreads?
Well, spreads are wide, George. Don't get me wrong, but actually, I think this fragmentation story, or the sort of breakup story, is a little overplayed. And the reason is what you're seeing higher spreads, but not with Italy and Spain, and Greece, which are typically referred to as the pigs, right? Portugal's, okay. Not with them really moving in a way that, say, they did, when Draghi came out with, his famous sort of intervention, whatever it takes, and then also the LTRO, which they kicked in 2011. Because actually what you're seeing bull steepeners, and the default trade is actually a bear flattener. And you're not moving that way. So I think really what you're seeing is a reaction is a bond market that's saying, I just don't want to own any European debt at this point, and I particularly don't want to own BTPs in this environment. But it's more because I think of the inflationary story than it is at this point a default risk. So I kind of think that's a little overplayed.
Julian, as long as we're on Europe, before we go on to Japan, what's your view? Do you have any strong views on currency, particularly the euro, and then we'll come on to the yen?
Yeah, I mean, as I said, structurally, I think there's a problem. I think the dollar actually is increasingly vulnerable. A lot of the longer term flows suggest a significantly weaker dollar, but for the moment it isn't happening, right? So if you look at lots of terms of trade, you look at all sorts of things, they are showing that the dollar should weaken materially, but the dollar isn't weakening. And so then you have to ask yourself, those flows that are being created by those longer term metrics, where is that money going? And what it's gone into up until now is the US equity market. So basically, foreigners have been recycling money they earned from the US back into the US to fund that spending by buying US equities. And that creates a lot of instability. I mean, it's the classic, George, stable, unstable equilibrium, where multiple things could go wrong to upset that balance and cause that money that's sitting in the US equity market to go home, causing the euro and the yen to rally. But it hasn't happened yet. Maybe it's because Europe's just such a basket case. We'll see over the next few months, and maybe this continues. But structurally, the last trade I had on, FX trade I had on, was a long dollar trade, and that was against the renminbi. And I haven't really been playing FX that much. Because it's just been kind of tough. But structurally, I'm a dollar bear. I just don't think we're there yet. And I don't think that capitulation in the dollar will occur, sir, until we get to a material bout of pain. So in other words, it is going to take the Fed faced with which in economic terms is called the impossible trinity, where you stick a gun to their forehead in an environment where bond yields are too high, threatening the stability of government, where the equity market is too low, threatening the real economy, where they are forced, irrespective maybe of still too high inflation, to pivot and come to the rescue yet again. And at that point, that's when the dollar, I think, will go, but we are not there yet. And this time, clearly, it's going to come from an awful lot more pain than we have seen since '08, I think.
Yeah. So Julian, if you had to hazard a guess, is that pivot a 2022 event or a 2023 event?
It's probably a 2022 event.
Okay, so
I would say later, probably later in the year. Right? I mean, I'm kind of a big believer if you can eke out, till sort of July, then in the equity market it doesn't implode. Then it typically is going to hold itself up until September, October. I could be wrong, George. You're a better equity guy than me, so you tell me when companies are going to start revising down earnings. Is it in the next? Is it in July? Or do we have to wait till August, September?
Yeah, so Julian, I wanted to come to earnings in 1 second because you and I spoke earlier today. But before we do that, let's just go back. Could you just mention Japan and the yen and the rest? Then I want to come on to earnings.
Yeah. So look, I mean, we write a separate Japan publication, and Georgia, an old colleague of yours or an old contact of yours, Jeff Usher, writes that for us. And Jeff has been pretty clear on the Kuroda stance, right? We've been defiant in our view about JGBs. We've just sort of said we don't think they'll go. He's going to hold his ground. He doesn't get replaced until next spring. There's lots of tension. There's been tensions around the currency, but mostly related to the electoral cycle in Japan. So that will kind of go away in the next few weeks too. So while I see inflation increasing in Japan, it's not nearly to the degree that I see it increasing in the US or in Europe. I think we're looking at 3.5% ex-food, which is how they measure it. A lot of that is energy, in fairness. We don't yet have the wage growth. So I think Kuroda's going to hold his ground. That means that dollar yen remains vulnerable in an environment where US bond yields can trade higher. I mean, it's essentially a quasi bond trade, but with higher beta.
Right. Okay, let's move to earnings. This has been great. When rapid fire, we're knocking these off. It's a wonderful tour de force. So you mentioned earnings. I believe earnings are going to be a complete wipeout. You just look at as a proxy, and I want to hear you're more sophisticated on this. You get in the weeds better than I, Julian. But I look at simple things like CPI, PPI. Using that proxy. It's not perfect, but it gives a good good indication of direction. And I think you're looking at a total wipeout. That spread is widened at unprecedented levels at a time when demand is slowing.
George, you broke up a bit,
we're losing you.
Pretty solid.
Yeah, he may have gone. So let me talk about earnings. And so I have been writing for a while, and I've used it in my presentations. And I think that the equity market, I think, is caught between a bit of a rock and a hard place. And I think it's brilliantly summed up by the chairman of Restoration Hardware in the last round, or last but one rounds of earnings announcements, where he came in, and for those of you who are listening from overseas, Restoration Hardware is a sort of bull market furniture store in the US, and he said, "I don't think anyone." Okay. Yeah, we can, George. I'm just answering the earnings question. So I was just saying, I think the dilemma facing the equity market is twofold, and I think it was perfectly summed up by the chairman of Restoration Hardware. So he came out and he said, I don't think anyone really understands what's coming from an inflation point of view, because either businesses are going to make a lot less money or they're going to raise their prices. And I don't think anyone really understands how high prices are going to go everywhere. Okay? So this is probably 3 months old, but I think it still is poignant, not least because while people looked at the final demand PPI and it plateaued a little bit, if you look at the old series, the finished goods PPI, it surged another 1+%, and it's now the highest that we've seen outside 1973, which is when we had the first oil shock, right? So this is remarkable, and it's running at 16%. So if you take that back to a simplistic thing, what was the chairman of Restoration Hardware saying? He's saying either we won't be able to increase prices, margins are going to get absolutely crushed, or if we can push them through, inflation is going a lot higher, and then the extrapolation is then the Fed's going to have to do a lot more, and the equity market's going to get crushed by higher bond yields. Okay? So when I look at that mix, I think he's absolutely right. I mean, our margin model suggests, which is a cost-led thing, so maybe we can get some productivity. The problem being at the moment is while firms, I think, would love to get the shiny new machine that replaces the very expensive labor that they're having to address, you can't get the chips to buy the shiny new machine, right? So for the moment, that productivity doesn't seem likely to come to the rescue. So when I look at our margins model, which in the S&P are currently just below 16%, the model suggests they halve to 8 based on costs, right? 8. I mean, that's the worst we've seen outside. It's worse than the post-dot-com bubble, right? Now, I think the good news in inverted commas is that most firms, while we've seen some that have struggled with passing price increases on, most firms still seem to, in the US, being able to pass those price increases on. But that just means inflation at the bare minimum remains sticky. And so I think that, you know, this is the dilemma. I don't think there's a get out of jail free card here for equities, because I don't see inflation coming down. In fact, it may not yet have peaked. I do see a Fed that seems intent. I'm told by all my old policy friends who, when I used to work with at Medley Advisors, who still talk to policymakers, that, you know, they've all read the minutes from 1973 and 1974, all the Fed officials, and they're determined not to be an Arthur Burns Federal Reserve and make those same errors again. That, you know, that means they're going to be tough, they're going to be hard, they're going to try and drive this thing, you know, gird their loins. They're looking at real economic data, which is lagging, and we can talk about why that is in a second, George. But I just don't see how equities really get out from under this thing, right? Because it doesn't appear to me that necessarily that those inflationary pressures are yet dissipating, and certainly not enough, right? I mean, if a firm's facing 16% price increases and they're passing on 6, well, then they're getting margin compression of 10%. I mean, you know, all these numbers are just horrible, right? It's just, to my mind, is not an easy time.
100%, Julian. Sorry, I broke up before I knew that was going to happen. I'm on the highway. All right, so let's go. That's fantastic, Julian. Let's go to some questions. We'll go to, I don't know, Tommy, if you have a question you want to weigh in, or Three Aces, or Joe Schmuckatelli. So whoever's got a question for Julian,
I'll start.
Please.
I'll start. Hey, Julian, how are you?
Hey, mate. Good.
Good. Nice to hear you on this. And as always, your comments are just so spot on. If you're like sleeping or waking up in the middle of the night, thinking about something that could go terribly wrong, let's say ECB, the Bank of Japan, the Fed, anything out there, what are things on your mind that just like the biggest concern that could topple basically everything? Let's say that it's a big mama black swan.
Gosh. I mean, I think a currency crisis in the Eurozone could be one, Tom, right? Let's say you get a truly horrible stagflationary environment in the Eurozone, and the euro just tumbles, right? Because the ECB is incapable of getting ahead of the inflationary situation. But let's say those consumer confidence numbers are really right, and the Eurozone goes into a deep recession. I think that's one. I'm not so worried about Japan. I mean, really, it's possible. You know, on the currency crisis front, the UK is another one, potentially much worse than the Eurozone because it has a big current account deficit as opposed to a surplus. The other one, which in the last 48 hours has been concerning me, are these, because it's just not on anyone's radar, is these new, more contagion and virulent strains of COVID, which are coming out again. The UK started to warn against them because these ones don't, they're as vicious as, they're as infective, as vicious as Delta, I think, and as infectious as Omicron. And they congregate in the lungs again. So, and there's virtually no protection apparently from vaccines or prior infections. Yeah, I mean, black swans, those kind of scare me.
Okay, that makes sense. Now, where, as far as inflation goes, I think you just answered the question I was going to ask. ECB is definitely behind the curve.
Yep.
Do you think the Fed has moved considerably back to where they should be right now with another 75 coming in July? Do you think that'll get them to a place of more comfort where they can
it really
back off?
Right. No, I don't think, Tom. I mean, the problem, I think the Fed will back off. Look, here's the thing. If you look at a metric of kind of Fed funds versus nominal GDP, right? And that's, you know, remember all those, Janet Yellen was talking about targeting nominal GDP, and there's a reason, right? I mean, it's a useful metric of sort of nominal aggregate demand, and you know, that's really how I've always thought that the world works, right? I mean, no one really thinks of, oh, my real pay packet is, you know, $98 a month, a week, not 100, right? I mean, no one really thinks of it in real terms. So I kind of like that metric. And if you look at that, where we are now, real Fed funds against nominal GDP, against real Fed funds is like minus 980 basis points. Now, some of that will be redressed as the Fed raises rates. But a typical tight level on that, in that ratio, is 0. So we are 980 basis points that either has to be apportioned, Tom, between higher Fed funds, lower real growth, or lower inflation. 980 basis points, right? So you start doing the maths, right? You know, let's say growth goes to 2. Let's say, you know, inflation goes to 4. Well, then you still got to get Fed funds to 6 to get that relation. I mean, you just start playing around with those sheer numbers, and it's pretty hard to see that the Fed is close to this yet. I mean, I think Powell, you know, the dirty little secret that a lot of macro guys like to keep to ourselves is it was never about rates. It was always about financial conditions. Powell's made that very clear. You know, as I said, if you look at where the Goldman Sachs Financial Conditions Index is, which is not a bad proxy for GDP, it's probably commensurate with about 2.25% GDP growth. That's not even fucking trend, right? So financial conditions aren't even tight enough to slow us to trend. Right? I mean, let's assume that ISM drops this coming week, which I think things have changed very dramatically in the last month. But let's forget, I mean, a mid-cycle slowdown where you typically got back to sort of trend was sort of 51, 52 for ISMs. I mean, we got so used to the damn thing sitting at 60, which is historically way above normal, that we've just got very arrogant about this. So I think the Fed's got a hell of a long way to go. The question is at what point in bubblicious .com style equity markets does the equity market drop? Because that, and George and I talked about this before, that's really the indicator. right? Because of what I call acute financialization or hyper-financialization.
So, Julian, let me follow on Tommy's question. Is the Fed, the Fed's talking the talk, and they're pretending now to walk the walk? My question to you is, should we really believe what Jerome Powell is saying, or is it that's all really a fig leaf? And really, there's the old argument, well, the only way you can deal with the debt is devaluing the debt, so we need more nominal growth. So they're talking the talk, but they really don't want to walk the walk. What they really want to do is inflate the debt away. So which of those conspiracy theories should we take them at face value, or should we believe the conspiracy theories we put to you?
My policy friends tell me you take the man at face value, and I am tempted at this point to take the man at face value. In total contrast to, say, the ECB, right, where I think, you're seeing a lawyer and they're double speak trying to lead a central bank. I wouldn't trust Lagarde as far as I could spit. But Powell, I think particularly with that interview that he gave on NPR, which I keep banging the table, I think is really, really important, because, it's almost like a personal solemn pledge to the bottom half of the American populace that I intend to deal with inflation and address the problems that you are getting. I really think that was important. So I'm tempted to take the Fed at face value. I'm not, I worked at a policy shop for, a decade, and I think these guys are well-intentioned. I think they're appalling at calling cycles, to your point earlier, George, right? I think they're, I have a friend who's followed the Fed. He has this expression, I've followed the Fed man and boy for 40 years, and they're always the most bullish at the top, and they've never caught a downturn, right? I think they're appalling at forecasting. But I don't think Powell is disingenuous.
Great. Okay, let's go now to the guy with the best name on Twitter, Joe Schmuckatelli. And Schmuck, after you, we're going to go to three aces. So Schmuck, good to see you. What's up, man?
Great. Thank you, George. Julian, I've heard you on a variety of interviews and podcasts. I find your analysis brilliant. It's just a real privilege to even be able to ask you a question. So thank you for being here today.
Pleasure.
Hey, I'm encouraged by the backing off of price and across the commodity spectrum. From wheat and soy to steel and iron and copper, especially. Copper is down to 18-month lows or something like that. I'm hopeful that this will weave its way through and help lower the inflation print going forward. I know it'll take time to do that. I'm wondering if you find a silver lining in that, and maybe it will help with inflation, take some of the pressure off the Fed. Maybe they'll moderate in the coming months, especially as we approach the autumn elections. I'd just like to hear your views on that.
So, it's not an uncommon view. I heard it articulated, excuse me, on CNBC yesterday. But I think it's missing a step, if I may, and that is to ask why are commodities coming down, right? And why are bond yields doing what they're doing? And they're doing what they're doing because the risks of a recession are rising. To my mind, that is not a bullish event for the equity market. Now, don't get me wrong, oversold, bounce off levels, come back to, 4,100 or something, maybe in a miraculous kind of world, 4,400. But the problem is that if equities bounce, you're not going to get the tightening of financial conditions you get in an environment where financial conditions aren't even tight enough to slow an economy. Right? If they bounce back too quickly and ease, we're still going to be growing at 2.5%, which in an environment where we've got massive inflationary pressures and wage growth, you will not right-size that labor market, which Powell has made very clear. So I think whether I call it the optimists on Wall Street or the algos who are just trading these correlations, I think you need to really look at why commodities are down. You really need to look at why the bond market is doing what it's doing, and in particular, the shape of the bond market, right? So actually what we're beginning to see is a bull steepener. Now, all the guys on TV, and once again, this is when I shout at the TV, will say, things like, but they're all equity guys, so they wouldn't even know what the shape of the curve was if it bit them in the arse. They'll say, like, the curve inversion is a sign of the bond market pricing in a recession. Bullshit. And curve inversion is the sign of the bond market when it's a bear flattener, inverting, is basically the bond market pricing in an aggressive central bank, right? And they're pushing up to your yields relative to 10s and 30s, and you're getting this curve inverting with the front end pushing yields higher. What's actually the sign of a recession is actually called a bull steepener. And that's where the bond market starts to look at what's priced into essentially euro dollars, okay, the front end of the curve, belly of the curve, and say, oh, I know central bank, you think you're going to get them to 3.8, which is where the Fed's told us the new terminal rate is, but I'm telling you, I don't think you are. I think that actually what is going to happen is we're going to get to recession before then, and you're going to have to back off. And that's actually what's beginning to show signs of happening. If you look at, say, 230s, they're starting to steepen that curve, and it's because the front end is rallying and yields are falling slightly more than they are in the 30 years. And that's actually the beginning of recessionary signs. So I don't take a lot of relief from that, I'm afraid. And the other thing is we've got, even if some of these commodities back off, your run rate on services CPI is about, or PPI I think is about 8%. So I can't remember, sorry, CPI, PPI, but the services are beginning to accelerate quite markedly here. So, that's I think that's the issue. I think it's going to be, as I said, if you are lucky, this is sticky. If you are lucky. If you're not, we still have further to push forward.
Okay, that's great. Aces, you got a question for Aces?
George, I've been thinking, right? I mean, hi, Julian. Nice
Hello.
to meet you. Hi. And Tommy, hey, brother. Unbelievable call on the trading bottom on Friday last week. Fucking nailed it. Tommy's my
let me see where I
short-term
stick the
trading
landing.
guru. Yeah, well, that's George. That's between you and the consigliere there. When does he sell? So, hey, Julian, I'm just curious. So we've been talking about the everything bubble here for some time. Starting all the way back to the pot stocks and everything. Up to across every asset.
Yep.
So it kind of, looks like the everything bubble here may be kind of behind us, with the exception to fund flows. When we look at fund flows here at all-time highs and consumer sentiment at all-time lows and $20 trillion worth of liquid assets seemingly have, gone to heaven, VC, valuations down, crypto like carnage. I'm just curious, do you have any opinion? Because, if we look at earnings and the S&P, 2022 number being 235, 237, and put a realistic, 16 multiple on what's probably most likely a 170, 180 number, we're looking at, maybe another 25, 30% or more down in the S&P here. But, with fund flows being the way they are and persistent like that, it still seems like this kind of everything bubble's still alive, if you will. Do you have any thoughts on that? Thank you in advance.
No problem at all. Yeah, look, I'm with you. I mean, my target on the S&P is about 3,000, and I think, you obviously can't play these historical analogies totally spot on, but I think, from a macro backdrop, I think the closest analogy is 1969, which was the second big wave of inflation that we saw ahead of the 70s, right? People forget that inflation it wasn't the 70s, started in the mid-60s with profligate, poorly timed fiscal spending, right? And this feels to me like the 35, 36% correction that we got back then. George and I were talking also about valuations relative versus nominal GDP as well, and it kind of feels like that too. But I think the in terms of equities, probably what's most poignant is that dot-com period. And I think you raised an interesting point about these kind of, rolling peaks that we had. And that's what happened back then, right? I mean, the peak in the NASDAQ was March of 2000, but that was a specky, spivvy little market back then, right? That's why I keep, tweeting out that chart, which was bang on, last September when we suggested shorting it, ARK against the NASDAQ back in 2000. Because ARK kind of was, or is, like the NASDAQ was back then. I mean, super long duration, highly speculative names. Sure, they've got some of the big names that you have now, like Microsoft still in the index, but back in 2000, those things were, embryos in comparison to the behemoths that they are today. So I think, that's something that that I think people forget. But the point is in 2000, the NASDAQ peaks in March. The S&P doesn't really peak until September of 2000. And the Dow doesn't really peak, which was the big boy back then, until May of 2001, when you go into recession. So that whole rolling top takes time. And to your point, you detonate the sort of lower quality assets one by one by one. But eventually, you get the big boys.
That's great, Julian. Okay, let's go on to Pete, and then after Pete, we go to Lynn. Pete, do you have a question for Julian?
I do. Can you guys hear me okay?
Yeah, perfectly.
Great. I just had some issues earlier today. I just want to make sure. So really appreciate these spaces. It's pretty amazing to have everybody here. And Julian, we've never met, but I follow your work. So I just have, just some comments and I guess some other questions from a macro point of view. Obviously we've seen this slow grind lower, hitting certain levels, from a technical standpoint, fund flow and all of that. But is this more of a behavioral kind of thing? Is this sort of a learned response over time? Are we seeing, is this actual new money coming in, or is this a rotation of more of a proceeds trade from a macro view? Where you start to see people are moving in and out, we get these bear market rallies, and that's kind of what they've been. But from a macro view, at some point, the question that really stems to this, is it a global, are we on the precipice of a global recession, or recessions that are going to be sort of dominoes, across different parts of the world? Do you see something in that nature?
So I think, as I said, I think it's possible that you could get a very ugly recession in Europe. I don't think you've got the conditions yet, but it's entirely possible. In terms of flows, if you're talking about retail flows, retail flows have been conditioned to, over the last decade, to buy dips, right? Continuously buy dips. And it's been a phenomenal trade. But my view has always been that the real problem for the market wouldn't come about from weakness. And this is something that I've debated from people. People are like, the economy is going to slow down, and I'll be like, okay, great. We'll just get ready for the Fed or the ECB or Bank of England or whoever else who wants to go and print more money and just buy more stocks. The real problem comes from excessive strength, because then they can't do that. And I think this is the point, right? Now we've got excessive strength, right? Some of that excessive strength is coming off the boil, but the inflation pressure isn't going to abate quickly. And it doesn't look like we're anywhere, as I explained earlier, between, relative Fed funds and nominal GDP. Not even bloody close. So I don't see how the Fed backs off. And, this is the point that we just found out about. I was saying 6 months ago, when people would say, well, yeah, but 20% down, you have to buy the S&P. And I'd be like, what happens on the day that the market's down 20% and inflation doesn't come down but goes up? Right? So I think that's where we are.
Julian, let me interrupt on that point specifically. It's very relevant. Do you have a view on the oil price right now? Because that's obviously very central to the inflation question. Oil's starting to wobble here. It's had a dirt.
Yeah.
Nothing big in the overall scheme of things, but what's your view on the oil price right here?
Look, the thing is, George, people have pumped a shitload of money into commodities, right? And I'm a structural believer in the commodity cycle. We haven't seen the dollar fall yet, which is the real kicker. We need to get this thing into that next wave, okay? And maybe it won't, maybe I'm wrong. But I think it probably will at some point. But there's a lot of money in these trades. And you're taking pretty much everything to the woodshed and chopping it at this point. So, you know, it doesn't surprise me that in illiquid markets, you're starting to see some of these pressures. But I personally, I think they're great opportunities.
So you'd be looking to not put words in your mouth. Great opportunities, meaning you'd be looking to re-engage on the energy.
Yeah, I'll be looking to re-engage. I mean, one of my favorites is sort of, XME against the S&P. I think that's, we're not there yet. I do have it as one of my sort of long-term trades that I put in my own book. It broke out of its long-term downtrend back in February. It's probably going to come back down and test that thing. We'll see if it holds. But I do think that over time, and it's a real big dollar trade, right? I mean, it's like buying silver or something like that. It's huge. But I think that's going basically from a ratio of 1 to 5 or 6 over the next decade.
So that's the real investment. Okay, I know you're running short on time. Maybe one or two more questions for you.
Yeah, that's fine, mate. Yeah.
We're going to keep the room open until 12:30, but let's go to Lynn. Lynn, do you have a question for Julian, Lynn?
Yeah, hey, thanks, George, for taking my question. Really appreciate the effort you are putting in here, letting us talk to these experts. Julian, quick couple of questions. One, I'm curious what you think the Fed really need to see, or at which point does the Fed truly pivot and not just pause, but start cutting interest rate? And let's take kind of market collapsing and really awful economic collapse kind of out of the equation. Obviously, if that happens, we're going to see Fed pivot. But let's just say we have market trading sideways, maybe down marginally another 10-15%.
Yep.
In that kind of condition, how do you see kind of what is the Fed's reaction function to data? Like, do we need to truly get to 2% inflation before they start cutting?
No, I mean, cutting's a big deal, right? I mean, this is the problem, right? This is what people don't understand, right? You're growing above trend now, not below, right? We didn't get above trend nominal GDP in the whole 11 years post the global financial crisis, right? So let's imagine we get the soft landing scenario, all right, where they've managed to slow growth down to, let's say, 1%. And let's say, and this is going to answer your question, let's say monthly prints on inflation are coming in at 0.2, 0.3, okay? And let's say the JOLTS numbers, the discrepancy between job openings and job hirings has narrowed and closed, which is kind of the metric that they're using, right? Which is about 3 million too high at the moment. So let's say all those jobs have got taken off the table, and we're back to 1% GDP growth, 1.25, something like that. They can't immediately start cutting there because we're just back to trend. I mean, this is totally different, right? Now the question is can you go back to trend and not go through that? Yeah, I'm kind of skeptical of that, right? I suspect, I will tell you that if you look at the equity market, if you take top to bottom declines in the S&P and you take it back 90 years, then a 30% decline, which is what you'd get if you get another 10% that you talked about, right? A 30% decline outside 1987, which was not really a bear market, it was more of a flash crash from negative gamma resulting from portfolio insurance. But outside that, you've always had a recession with 30% top to bottom decline in the S&P. And by the way, you don't always stop at 30% declines, Right? If you get a recession, the question then is just how nasty a bloody recession is.
So, Julian, that's great. We're going to keep the room going, but you've been very generous with your time. I know you had a 12 o'clock stop. Let me ask you
I've
one
probably
final
got
question.
another 10 minutes, George. It's fine.
Okay, let me ask you one other question. So, for the average investor in the room, someone who doesn't have access to highfalutin, yield curve trades and swaptions and all this other stuff, for the average person in the room, pretend you're them, what would you tell them to do? Should they be in stocks, bonds, cash, be defensive, aggressive, long, short? Like for the average investor who's not day trading this thing, what would you tell them to do?
Well, I wouldn't tell them what their financial advisor tells them to do, which is just you can't time the market, because that's bullshit, right? There's a whole industry that's built around timing the market, and most of us are pretty damn good. So at this point, and we've been telling our clients, you can go look at my clips on Fox. I was saying back in November, time to be cautious, time to raise cash, time to be cautious, time to raise cash. I still think we're in that time, because I do not think this is over yet, right? I mean, if I'm wrong and this market rallies and, I lose some silly little moving averages that keep me kind of honest, and I just got the sell signal back, at 4,400 on the S&P. It kind of tells me that the target, the average decline is towards about 3,300, 3,000, something like that. It's not that far away. So I'm still highly cautious. I mean, I think if what would I be buying? Not a lot at this point, right? I mean, if you go back to that 2000 analogy, George, I use this expression, you can get, what we saw US growth rise disproportionately to value. But you can look at that metric, whether you could say tech against EM or tech against minings and metals and oil, or US against Europe, right? Whatever those metrics which are pushed to extremes have started to correct, just like they did after the dot-com bubble, okay? But there's two ways that a ratio can correct. There's the nice way, okay? The nice way is that the cheap asset, let's say minings and metals, can rise, and the expensive asset can just sit there and lose relative value, okay? Or there is the nasty way. And the nasty way that the ratio corrects is that everything drops, but the growthy stuff just drops more. US tech drops more, right? And that's what we've been seeing thus far. And that's what you saw during the first half of the dot-com bubble burst. And I think we're about halfway in that process. Only when the dollar started to drop did you see the nice correction, right? So when the dollar stops and the Fed pivots, everyone's going to tell you to go and buy US stocks, right? Be far better buying other things than US stocks, unless you buy very dollar sensitive stocks like minings, metals, energy, companies with huge exposure to EM. But you're much better off potentially buying stocks elsewhere in the rest of the world, or commodities, or certain emerging markets, right? Far better. But so far, I still think we're in the nasty correction, George. So it's very hard to recommend anyone buying anything.
So, I apologize, my reception's poor. So, Tommy, if I fade out, you need to run with the ball. Let's go over to Shrub. Shrub always, Shrub's one of the sharpest guys in these rooms. Shrub, you have a question for Julian, Shrub?
I was quite interested about, look, the one observation I'm going to have here, Julian, is everyone's thinking about the Fed pivot. And I think that's what's keeping the money in the market. So, as George knows, I just follow the flow. So, look, this year there's been 195 billion of inflows in stocks. So I think we're all conditioned that the Fed is going to pivot at some point.
Right.
So it's just, at this point, it's like a frog in a boiling pot. So I just kind of want to stay on that path, if you don't mind, because even if you think or I think that the Fed pivots in October, although it's 3-4 months away, 3-4 months away in the market, we might say, you know what, I'll just be patient. I'll just wait for the pivot.
Right.
Which is what happened, it's what people were saying in June 2008.
Right. Right, and this is the point, right? When do they pivot? As I just said earlier, this time I think is dramatically different from any period that we've seen in the post-GFC period, right? Because the put is significantly lower because of inflation. And what's happening is that those inflows are anticipating that put and not understanding that the dynamics this time are very different. I don't think you need to rush to buy that, catch that falling knife. I think you can wait until the market starts to rise, right? I mean, you could still catch 75, 80% of the move and not catch the arse low, all right? Particularly, it's very different if you're a hedge fund, right, where you're trying to leverage, right, and catching that low is singularly important. But I just think until predominantly that retail money has been beaten out of the market, it's nigh on impossible to see a low. I mean, I look at standard metrics like the VIX, realized vol, cross correlations in stocks in the S&P. None of them are even remotely close to capitulatory levels, right? So I just don't think we need to rush to do this. And my gut is we are halfway through this bear market, and the next leg of the bear market will come via a revision to earnings.
Can I add one thing here?
Yeah, absolutely.
If you don't mind.
Go ahead.
So the other thing to note is unemployment is still very, very low. So we're still below 4% unemployment. So if you don't mind just expanding on that, because my sense would be the Fed is going to keep trying to break things until unemployment has to be at least 5, right?
Well, I mean, typically a 0.5 rise will do it. But as I said, I mean, they've talked, he hasn't talked specifically about jolts, but we know it was one of Yellen's favorite metrics. And you can get that breakdown between jolts higher and jolts job openings. And you can see that it's like historic extremes at the moment. And I think that's the metric I'd watch personally, as opposed to the unemployment rate. And this is kind of why they keep talking about the soft landing, because they're hoping they can nudge down those job openings without cutting the actual hires, right? I think that's overly optimistic because of that feedback loop between CEOs' behavior and their stock price, right? Because they're only paid to be shepherds of the stock price. So as soon as their stock price starts to fall, they start to cut jobs. So that's the big problem. And that's also the big problem, I think, is because the Fed is looking at the real economy. They're looking at things like that inflation data. They're looking at that job data. Both of those are traditionally very lagging. What they've taken their eyes off is the equity market. And if anything, they're cheered by the correction in the equity market. I mean, let's not forget, right? I mean, Apple stock rose 240% post-COVID, right? So this dip, as far as you're the Fed, is like, who cares, right? I gave you 240%, and now you're bitching and moaning about, a 20% correction. Shut up, right? But the point is that stock correction does influence, as I talked about earlier. It's actually that which leads these PMIs, and the PMIs are about as good a leading real economic indicators you can get, but it's stocks that lead the PMIs. And it's the correction in the equity market that will get us into a recession through that feedback loop for CEOs' behavior. And I'm afraid by looking at the more lagging real economic data, we're actually going to end up making a policy error.
Julian, I can't thank you enough. This has been absolutely wonderful. We're going to keep the room going for another 15 minutes or so, but you've gone overtime. I know we've all learned a lot. I really have learned a lot. I hope you've enjoyed this. You certainly have taught a lot of people, and I hope you'll consider coming back again in the future. It's been fantastic, and we'll keep watching. Everyone should follow Julian on Twitter. He's also, you can see him on Fox Business News, and he does make some sporadic media here and there. But Julian, good guy. He's a must follow. You follow Julian. A lot of other stock guys we've had in this room, but he's on my must list, top of my must list. So I want to thank you, Julian, for coming into the room. This has been fantastic. I hope you'll come back again.
Pleasure, George. Thank you very much indeed, and thanks everyone. Yeah, if you want to get hold of me on Twitter, it's @JulianMI2. So have a good one. Thanks very much, guys. Bye.
Excellent. So, Thornton Shrub Ace, any comments, thoughts, reactions about what Julian had to say?
I think. Go ahead, Tommy. Sorry. No, go ahead.
Julian's very measured, the way he sees everything, and he sees things in I'm more fast motion. He's very slow motion of how he sees things, and I think that if you could take away some of his from this, how he sees things in a longer term perspective. A lot of us are very focused on the short term, and I think it brings a really, really solid balance.
Yeah, no, I mean, what I would say is his comment on the Fed pivot, I think, is just very important because we're all on the same page. We all know the Fed is going to pivot, but but the Fed is going to the Fed put is just much lower than where we are now. So I think that's the biggest danger, because I'm speaking with a lot of family offices, and a lot are invested. Most of them are fully invested. Only one is sitting in cash, all cash, and he's the only guy that said, "I just want to see this recession play out in full because I've seen this many times." But everyone else is just betting on the Fed. So I think it's just very important to understand this dynamic. Many arguments that they argue is, oh, look at all these stocks are down so much, or the wealth distraction is $16 trillion of wealth versus $8 trillion in 08. But the Fed doesn't really care about the wealth destruction right now. They care about inflation. So,
yeah, that's their mandate right now. And as Julian said, they're not necessarily crying over the equity markets falling apart or the bond markets falling apart. It's doing their job as far as the financial conditions tightening. So that's, and he called that way, way back that was what we're going to see. The one thing that's really interesting, and we didn't really get into it as much as I thought we should, was the whole earnings aspect of how all of this inflation, all of the slowdown, how it's going to hit earnings. And we have earnings starting in, well, I guess next week we have Jefferies, and I'm watching that one really close for financials. But we have Q2 earnings hitting, and I think that it's going to be really, really important to see the ones that give the negative guidance. And then again, you look at a FedEx that is up 6.5% today. Their numbers were fine. The new CEO gave a bright outlook, which new CEOs tend to do. So I think it's going to be really indicative. The one thing that I thought of also with the CPI, we're going to get the June CPI in, I forget the exact date, in July, but it's going to come in hot. There's no doubt that it's going to be a hot number. And the thing is, as everybody knows, it's a lagging indicator. So we've had a lot of commodities pull back, especially the very important and most watched energy component has pulled back considerably. So you could see the Fed again going 75 in July, barring any earnings debacle. S&P at 3,200, they might go to 50. But I think you're going to get 75, and then you're going to see the July number in August start to come in weaker. That's my call right now, and I think the Fed may start that pivot where they will go, well, 50 is the next one after, I think, is the consensus. Maybe they'll go 25. And then you have the midterm elections, and the Fed historically has tried to avoid being partisan or have some influence on the stock market or around elections. So I think that it's going to be really interesting to see how that develops. And the other thing is, if you go back to 2000, you had an equity market down pretty hard in Q2. Q2 earnings came out, not great, but the market rebounded into August and September, and then the earnings started to really, really show up with huge pre-announcements across the board, especially in tech, which is what Julian was getting at. So that's kind of a little 2 cents right there on the earnings front.
Hey, George, couple things.
Aces, go ahead.
Just a couple observations. An article came out yesterday that gasoline consumption year over year thus far in June down 8.5%, 9%. We had an article, a B of A report this morning. Credit card transactions were growing 30% in mid 2021 are now negative growth year over year. There's tons and tons, of massive, demand destruction type things going on out there. I just wanted to put that out there. And those are current, leading indicators here, not, things. Yeah.
I'd like to. Hey, Baron, you have a question? You have something you'd like to talk about, Baron? You there, Baron?
How you doing? Thanks, George. I was just going to comment on Julian, what Julian was saying, which was I missed him, but it's about the softish landing. That reminds me of just I just kind of have this opinion that basically what they're doing is navigating us through the waters here, where they don't want to kill jobs, but that's what's happening. As I said last time we spoke, it's basically the pink slips are lined up for the initial 10%, and if the Fed, through their controls, through whatever, let's just keep tinfoil hat off here, basically controlling the VIX, et cetera, they're able to navigate the market lower, but keep it at a certain level for a certain period of time. They can actually circumvent mass layoffs and only get a certain percentage of layoffs. Well, that would allow them to continue to raise interest rates, scare the market into the next period of the summer, where in the Q3, just before again fall, before the elections. And that would be if they're able to do it successfully, where they have another period of layoffs. That could be the point where they could pivot. But again, that, like other people are saying, I keep hearing about these people just thinking I'm keeping my money in because I believe that the Fed's going to pivot. This is the bottom, and no way in hell. They're tapping this down to whatever level it's going to be, lower from here. But this is not it. I'm with you, George.
Yeah, Baron, I would just say stuff I'm looking at, stuff. Trackers.
Hey, George, we're losing you again.
Sorry.
George? Okay, we've kind of lost George here. Who would like to speak?
Oh, hey, Tom. Okay. Pete Carmsino here. I just wanted to kind of piggyback on what you were just talking about and what I think Baron had mentioned. And it kind of comes full circle into, the Fed. It's always been, to me anyway, it's not so much what the Fed does, it's what they say they're going to do. And then the market reacts, and then they take it, one step at a time. And as Baron pointed out, that's what's happening. But also that demand destruction that Three Aces talked about, would you agree that it could be part of the whole wealth effect? Because we heard from the former Fed official, Bill Dudley out of New York. He basically said, look, that's what the Fed has to do, right? They basically have to create or damage, so to speak, the wealth effect, which is a psychological effect, and then you start to spend less. I mean, is that sort of what you're seeing as well?
Well, I'll take that. Yeah, they are going after the wealth effect. Unfortunately, the more they do this, it doesn't necessarily affect the upper tier of the terrible wealth inequality that we have in the country. It's going after people that are in the stock market, and that's not necessarily the people that are being hit with inflation. The thing that I thought, I don't know if anybody, well, if you could watch the congressional testimony from Powell, it was really indicative of how partisan especially like Elizabeth Warren was going after Powell because of the job layoffs that are going to occur. And, look, this is a situation that Powell has to do. There's no easy way around it. Everybody's talked about how this Fed and all central banks have been, painted themselves into a corner. And it's just, this is the natural process of what happens when central banks have to clamp down on inflation. The one thing that a lot of people don't get is this, a lot of this inflation hasn't been necessarily by just huge demand. It's been also because of supply chain and demand or supply shortages. So that brings another element to this. And that's why a lot of the energy bulls that I know are just adamant that you haven't seen the highs yet in energy. So that's something I think that the Fed, I don't know if they can really affect it that much when you have the supply problems that we have right now.
Hey, Tommy, could you just talk a little bit more about energy? You had a great call. Where are you in the continuity of your thought process? I will just say as an aside, I mean, look, this is a very humbling business. We all get it right. We all get it wrong. If you're any good, you're wrong 40% of the time. But I've really been taken aback by some of the tomatoes, brickbats that have been thrown by some energy bulls that anybody who articulates anything less than a maximum bullish position. And I was out in the vanguard being bullish energy, up until a few weeks ago. And I know Aces took some heat for his standing down on his bullish energy view. I did. Helene Meisler, who is a highly regarded technician, Helene, we all worship her. We had her in our space a few weeks ago. I posted something this morning, her commentary on the price action energy sector. I mean, people just start throwing the insults right away. So to me, there's information content in that, but I don't want to put words in your mouth. So what did you think about the energy stocks right here, Tommy?
Well, I'm not. I'll tell you that there's a lot you can listen to on Spaces, and not just this Spaces channel. There's a lot of energy bulls in other spaces that I listen to, and the bottom line is right here. As far as from my technical viewpoint, energy has a pretty good shot at bouncing. We have a lot of DeMark buy setup nines, which is sort of a shorter term indicator for DeMark. At the top, and I mentioned this before, we had sell countdown 13s, and not only on the daily, but we had it on the weekly. And I was really unpopular with some of the Canadian oil mafia, who I have a affinity for. I like them a lot, but it's not personal, it's technical. But I think right now you might be able to see a bounce in this group. I still think the overall market can continue to bounce. It's not necessarily going to be straight up like today, but choppy, perhaps getting over 4,000, maybe 4,100. And then, like Julian said, you can let some go and lay it out there to short into it. So that's my view as far as energy right now. I think it's a little overdone. If we continue lower, then we could have a new sequential countdown start, and that would extend the down move. I don't see that happening right here.
Tommy, let me manage to be precise. It's hard enough getting the direction right, but I totally get. I mean, look, hats off to you. You made a great call on the top, so you got cred. And if you just want to say, hey, you know what? I got paid on my short. I'm done. I don't know. It could bounce. That's fine. That's an answer. But again, for the average person at home, I hear what you're saying loud and clear. It could bounce. But if I were sitting, and I'm not in front of a screen, but I remember from this morning, XOP was 130 or something like that. Just using that as a placeholder, as it for EMP. If I said to you, where do you think, energy ultimately goes? Like, do you think throughout the course of the rest of this year, the balance of this year, you're going to see meaningfully lower levels of energy, or is that too hard to call? And you may say, well, gee, George, I don't really know what I think. I have higher conviction in my short run than my intermediate and longer term. So when you look at structures, short term, you made a great call. Hats off to you. But looking beyond the very short run, where you're saying it might bounce, do you have any view? It's okay if you don't have a view. Do you have any stronger view about the intermediate to longer term on energy, Tommy?
A lot of times when you have these long term uptrends, and then you get the not only daily and weekly DeMark sell countdowns, you get a first move down, and that's wave one. And the next wave, I'm just going to speculate, could be a lower high wave and doesn't get back up to the old highs, and then we start to fade again and move lower into, if we break the recent lows, then it moves into wave three. So I'm kind of going a little further out before it's actually, too clear in my mind. But that's kind of my view right now. When you have these longer term sell countdown 13s on a weekly, I mean, overall the entire market, X energy last year around December had just a ton of sell countdown 13s across the board within the S&P. The other thing is we're starting to get, and those were the only, energy was the only sell countdown 13s a month ago that I was seeing, and that was it. And now I'm starting to see a lot of buy countdowns and some on the weekly standpoint as well. So it's giving me, that kind of was part of the reason why I turned a little bit long currently for a bounce. And trust me, I'm agnostic this year as far as being bullish or bearish, and I think that I'll get some right, I'll get some wrong. I just want to have the ratio work in my favor.
Again, I have no commercial relationship with Tommy. I've known him for a number of years, and he annoys the heck out of me when he calls these bounces. He's usually right. He did it again. He's a must follow, and I'm sure his research service is extraordinary value for the rather modest prices he charges. So I'm shamelessly plugging for Tommy because he's one of the best in the business, and I read his work every day, and I urge others to do likewise. I can't think of another research. There are research products which are as good, but the value, what he charges, is just ridiculous. So I urge everyone to run, not walk, to subscribe to his service. Again,
thanks, George. It's very nice of you.
All right.
By the way, guys, I've got to jump off. I've got a call coming in at 12:30 here. Hope everyone has a great weekend. George, thank you as always, and everyone have a great time. We'll probably be on this tomorrow, right?
Great, thanks. All right, we're gonna do one more question. We're gonna have Carpathia wrap it up, and then we're gonna close the room. Carpathia, my friend, good to see you. What's on your mind, sir?
I just wanted to jump in and real quick. These are fabulous. I want to confirm, which I think it was Shrub was saying. I have a small practice. I sent a free little journal out, and there's huge resistance to actually accept that the great moderation is ending, for lack of a better term. And I sent an email out this morning about, heck, hey, you're getting your rally, but everyone in these spaces, I think, not every, the ones that talk, we're all trying to look around the corner, and that's extremely valuable, and that's where I cut my teeth in 80s and 90s, and I think it's extremely valuable. But Bianca was at Saturday's space where there's 4.5 trillion. It's totally mechanized. So part of the skill set we have to, decide is we don't really know. We know we're in this sort of backwash transitionary zone with the Fed. And, we know we're going to have a hot number in July, right? But then you have this, I call it each year I had to, now it's up to 2022. I call it HAL 2022. And it doesn't think. It's reactionary. And it's the rebalancing, the tactical. So we have this, we're trying to look around the corner and we're trying to make sense of something. And this is extremely good spaces that George, it's revolutionary. I sent you a PM. We got to keep this going because I'm starting to see, even though people are resistant, I'm getting a little bit of feedback about, oh, is this what you're talking about? So the bad thing about the HAL 2022 is it's totally reactionary. It's dumb. And it's based on what used to be a good thesis, hypothesis, but now it's just mechanized, rebalance, yada, yada. But I'm sitting here looking at my screen. I'm a little long. I hate being a little long. It's green, but that's from knowing we're going to get this rebalance. And we got to learn to play with this thing around our neck. I don't like it because it's just creating the stupidity that goes on. So, anyway, that's my comments. It's not really a question. And I think we got to keep trying to look around the corner and then try to use this machine, HAL 2022, to our advantage, like right now. Go ahead.
Your wisdom, your friendship. Sorry to get back to you. I've just been jammed the last couple of days. I've actually been doing this space. The reason the reception's gone in and out, I've been driving from Westchester up to Boston, so I'm multitasking. But I'm sorry. I will call you. Apologize for that. Anyway, thanks for the wisdom. All right, listen. We're an hour 33 minutes. This has been incredible. The last couple of weeks has just been, I don't know what to say. I mean, I look at what we've done. I say, how do we do that? I mean, between Bianco and Meisler and Amy Castor and Chanos and Belkin and now Brigden, and I left out some names. Again, you will not find a better space on Twitter than these spaces. And, I'm not just doing this for you guys. I'm selfishly doing it for myself because I'm learning a lot too. This is just unbelievable. And you guys make the space. You ask the great questions. We'll keep trying to keep the caliber up. Anyway, I don't know if there'll be a space this weekend. There won't be one tomorrow. Maybe there'll be one on Sunday. I don't know. We'll see what happens. But I want to thank everyone. Aces, Shrub, Carpathia, Baron, Pete, Julian, he's gone. All of you. This has been awesome. We'll do it again. And, have a great weekend. Take care, guys. Bye-bye.
Thanks, George.